just like to start by saying thank you to those of you who've made it. More people will join, but it is after lunch on the second day of a conference, and the sun is shining. So thank you very much for actually coming in. This should be a lovely discussion. I'm going to ask our fellow panelists to come to the stage. You may have noticed that there's a big, long list of them, so we're not going to give them a big introduction, but you can just give a round of applause to these wonderful human beings who are... And you'll see how well prepared we are because we haven't chosen seats. So, I just wanted to take a couple of minutes at the start because this is a slightly different kind of panel, I think. And I've already referenced the fact that you're here in the afternoon. So we want this to be a discussion between the panel and you guys. We've got about 60 minutes, and the idea is that we'll spend about half of it getting insights from our experts and sharing from this side of the table. But we really want the last half hour to be a discussion with you guys. We're a smaller group, being the second day of the conference, so it'd be great to get that conversation going. As always with these things, we've got to find some way to actually get you voting, get you involved. So we're going to go very low tech in the second half of this session, and we're going to just ask you to raise your hands like this. So I know there's possibly some accessibility issues. I don't mean it, but if you can raise your hand, that's great. And maybe just to start us off, since there's a few of us in the room at the moment and more joining, could you actually just raise your hand like this if you're in the right room? It's an important question. So if you're here for mission-driven capital, I noticed none of the panelists have put their hand up, which is, yeah, that's worrying for a start. And I suppose the other question I just have for you before we get going is, could you also raise your hand if you have an idea or a definition of what mission-driven capital actually is? Again, the panel is worrying me, but that's fine. Yeah. OK, cool. That kind of puts us where we are. So I think the thing we were worried about when we were talking about this panel is very much how we connect it to the last 2 days of what we've been doing here. So the idea, and you'll have heard yesterday and today about blended finance, you'll have heard about pension funds, long-term capital, patient capital. It is a mix, and we do need all of this capital to come together. What we're going to be talking about now is around what mission-driven capital can do, but also what an opportunity that is for other capital holders. So not going to give a big lecture on the spectrum of capital. You can find it many places, but everyone's in it, everyone's part of it, and that capital has to do better to actually help the world, help the planet, and actually make the system work better. If you want to make more money, this system has to work better as well. So with that in mind, my final 2 points on that are very simple. We talk about a spectrum with philanthropy on one end and investing with no mind to impact at the other. And underneath it, we talk about, I don't know, the characteristics of capital, some patient, some long-term. We have pension funds needing money in 30 years. We have other motivations that go across that about wanting impact or wanting return. But a bit like the video this morning, I just want to kind of highlight that capital doesn't have any of these things. Capital is inert. Capital does what we tell it. We put the characteristics on capital, our organizations do, our needs do, and what we want to try and do is find the best capital for the gaps that we have at the moment. That's what we're up to. So happy to have a strong debate, happy to have back and forth, but we want it to be collaborative because, and this is the final soapbox bit, we don't really have a lot of time to wait. So we can talk about big numbers and billions and gaps in development, and we can talk about needing to help different parts of the world and the political implications. But the simple fact is the world isn't as good as it should be. We can't wait for the next generation to do anything about it because we can't be that arrogant. And also, I don't really want to live in the world as it is at the moment. So, unless you're 100% happy with how the world is at the moment, I'd suggest we need to collaborate and find a way to do it. So that sort of mindset in mind, we're going to go over to the panel, and I've just asked them, because we have prepped, which will surprise you, but to ask them to just give us a little bit of their background, understand where they're coming from, and try and answer 2 questions, like, what is mission-driven capital for you guys? And also, how do you know when you've done it? I mean, how do you measure success and what it comes from? And the idea is that we'll have a round of that, we might have a follow-up question, and then we'll come back to the audience for that open discussion piece. It's not going to be one way. The next big question is, who wants to go first?
Yeah.
Happy to start.
Happy to kick it off. And then the question is about what mission means to us.
Yeah.
And certainly for us, for Philips Foundation, and certainly when we speak about the Philips Foundation being a corporate foundation, mission is rooted also in our DNA. We are a corporate foundation, which means established also by Philips more than 10 years ago. And Philips itself is a mission-driven company. So we, as a company, Philips has a mission to reach 2.5 billion people by 2030 on an annual basis. This is normal business. And of course, when we speak about Philips Foundation, then we have a mission to reduce inequality and reduce the challenge around equitable access to healthcare. So our mission is to reach 100 million people by 2030 on an annual basis, those people that don't have access through the normal channels and the normal operations we do today. I think that is our actually mission, how we develop it. We do believe that collaboration and innovation can be then the game changer when it comes to changing the system. And I would like to share a few examples also to bring it a bit closer. What I mean with that is that I would like to bring you a bit, because we have been speaking 1.5 days actually mainly about how we do investments and where the one is mandated and the other not, and the other way around. And I think we need, when we speak also about mission, we need also to bring it to the context where we act in. And I would like to take you then to a context where we talk about people who don't have access to care today. And what it means is that if we look to, for example, someone who is a blue-collar worker, living in an environment that is actually depending on a wage, a daily wage, which might be below than $5, and they need to access healthcare. And then, of course, they're left with the choice between two things. And the first one is the public system that's probably not functioning. And that is the case, actually, in most of the regions when we talk about the Global South, or between the private sector that they cannot afford. And we look to those solutions that can leapfrog exactly in that middle and make sure that those people can get the access to the care that they need and that they can get back to their business operations that they are expected. Because when they get sick, then of course they need to, to compromise on that day of wage. And not only that, often what happens is when they postpone their care, then of course we get into another more complication, which brings us to actually socioeconomic challenges, and means that then the cost of care increases, because whenever a disease gets complicated, we know the consequences of it, but also the outcome of care is much more challenging, and that is something we all pay, whether it is public system or private. And that is the play where we try to act, and that is what's mission for us mean.
That's a nice way to just set the standard. I can tell people are dying to go after that. But I don't know, like Stefan, since you're the...
Yeah, it's quite complementary, actually. I mean, we're not only, so Bayer Foundation is the corporate foundation of Bayer as a company, and we're not only active in healthcare, but also in agriculture and nutrition, and in the intersections. And I think that's also one of those key elements that there's always, especially if you talk about vulnerable communities in low and middle income countries, smallholder farmers in rural regions, they always have multiple challenges that can be addressed, and collaboration is one of those key elements here. So for us, we have quite a similar target in terms of the goals, like Eddine described, and I think many corporates also have those. We work alongside the corporate 2030 ESG target agenda and want to be complementary here to pay into those also 100 million goals, actually. But honestly, this is important, and that's kind of the bread and butter business. You need to generate auditable data and so on and so forth. But I also wanted to bring into the discussion here a little bit the so what, what, like Eddine said, what does it mean? So impact or mission-driven capital, what does it mean? For us, it means that somebody actually benefits, and you can prove that they do. So put your money where your mouth is. And my issue a little bit, and I'm going to consciously put some controversy in the room, is the jargon, because then it kind of gets lost. So why, okay, we can talk about asset classes and all of the different complicated measures in which capital is parted. But at the end of the day, it's about, yes, we also want returns, right? So we want to get more money back than we put in on some level. But, if you talk about impact-driven capital, who benefits? And that should be the first thing that you think about, and then you think about what actually comes back. And this, for me, mission-driven capital is what foundations can do, because philanthropic money is 100% risk anyway. So we're giving it away, and we can use it to encourage investment and then put it into the broader spectrum of what the finance world is talking about. And this is reached through all these different targets that we have and measurement and how you measure. We're going to talk about that, but especially through collaboration. And I think this is why we're sitting here, because you need to leave the silo and really actually work together with less of an ego, because otherwise we're never going to solve any of the challenges that we're facing here. So this is more the mission element for me.
Cool. And we'll come back to some of those, but I'm looking at you two. Cheyenne, do you want to go? Yeah,
definitely. And I always find myself just nodding when I'm with these guys. I'm like, okay, this is what I want to hear, and this is what we're trying to steward. But from Draper's Rich's Kaplan Foundation, which is the global venture philanthropy firm, and we find, fund, and support highly innovative, inspiring social entrepreneurs that are tackling the most pressing societal needs and are helping those most vulnerable. And that is exactly also the term when it comes to how do we measure impact, how do we measure our success, is where we never compromise on the social return. So we really see mission-driven capital as saying we are maximizing the social return, and especially measurable social return, instead of maximizing a financial return. And that's something that we have done for the last 22, 23 years now as well. And we do it across sectors, we do it globally as well. So we are letting go of the most metrics when it comes to specifically the health sector or the education sector, but we are helping organizations that are providing shelter to those without it, that are providing food so that kids can actually have a nutritious meal before they hopefully go to the schools as well. But how we measure it is how many lives have you touched. And that's just jumping off of the exact thing that Stefan says as well. We want to make it measurable. So having one key metric across our portfolio that is global and that is sector agnostic, how many people have you touched? And one thing that we are really adamant about, the harder you double down on increasing your social impact, which is something that we do, the further you will get from getting any unbuffered financial market rate return. But for us, that's a compromise as a philanthropic funder. That is something that we want to do. And I'll leave it at that for now.
Yeah, and I think that very much aligns with the way that we look at mission-driven capital. We're at an impact investing conference, so everybody is thinking about his position in the continuum of risk, return, and impact. But compared to what I heard earlier in other sessions is that it's the question where you have the flexibility. So we are a foundation, and basically we invest our endowment with you guys. But within the foundation, we also have a venture fund in which we invest in very early stage companies. But we have no flexibility on the mission side. So the mission of the foundation is driving change, improving health. We have an ambition on making sure that people throughout the course of their life experience the best quality of life. And we have no ability to or no flexibility to compromise on that. So our mission is first, and we have more flexibility on the return and risk elements. And towards the catalytic, so the way we look at impact, it's actually on different layers. First is basically the primary goal. So as I said, there is no compromise on what the company wants to achieve. But we also look at the development stage. So we look at stages in which there is still very little capital available, so we invest in the earlier stages. Most are technology spin-outs from universities or research institutes, trying to show that this is actually a viable business. And if you measure that in terms of what do you want to achieve and what is success, for us success is if someone else wants to fund it. So I always say we stay as long as necessary, but as short as possible. When we can't get out and you want to take over, be our guest. We are catalytic in a sense that we want to reinvest as soon as possible. But the third layer is also that big societal challenges require transformation. So, and in a transformation, a lot of the circumstances around this company also need to be adapted. So you need to change regulation, you need to change reimbursement, you need to change protocols, especially in healthcare. You need to change the mindset of people. And that is just an investment that you're making into this institutional environment around a company, which is not necessarily a return on investment. First of all, it takes a lot of time. And secondly, it's something that is a kind of a non-competitive environment in which competitors also benefit from if it's actually achieved. So the catalytic role is that you try to change that environment in which businesses can flourish.
Perfect. And I mean, just coming back on that, because I really like the thing about success if someone else wants to fund and that kind of piece. I mean, without overselling it, like we're coming into an event with people coming from different viewpoints and different capital. So I suppose if there was a question around what's the opportunities for people to, I don't want to use the word take advantage, but take advantage of mission capital. I mean, what do you bring to make those kind of deals more appealing or more effective for them?
Well, I wouldn't say that we need to make them more appealing, but we need to make them appealing as such. So we invest in a company to make sure that it develops itself according to, and if it meets expectations, if it can show its track record, and that it's the requirements that I would say more traditional investors have before they step in. If that's achieved, then we don't need to invest any further. And it relates a little bit. Do you stay with the company until the end, and maybe the return is at the tail? We are okay with accepting that we step out in a secondary transaction because we just want to recycle the money.
Okay. And I think also, Stefan, you mentioned earlier about that lovely phrase about philanthropic capital being 100% risk capital, which we could debate, but yes. I mean, from your point of view, like, what do you see as that opportunities that you going in as early investors brings?
It's, in principle, it's the same thing that Matthijs said, but it's, I mean, I always use this example of the insurance case for smallholder inputs, where we, through a pilot kind of mechanism, demonstrate with little money, we're talking about $200,000 or something for a pilot, to demonstrate to a government that smallholder input insurance actually works. So as a concept in these volatile environments, people don't trust it and so on. The government doesn't want to step in because it doesn't want to take risks and so on. So we can, with that 100% risk capital, take a model that we know works, demonstrate to the government that it works, demonstrate to the target group of stakeholders that it works. Then the government picks it up, which happened in that case, was in Zimbabwe. So with the 200K, there was a $6.5 million investment from the government to insure from 31,000 farmers that we insured, 1 million farmers. And now 3 years into the project, it's 30% of the population of the country that's insured because of the subsidies of the government. And now the government starts scaling down its subsidy because the model in itself is self-sufficient. So there is a market mechanism behind it that's investable. You just need to make sure that this target group takes it up because they wouldn't or couldn't, you know. So, and you change the game through these kinds of interventions, and at the same time, you don't depend eternally on government intervention or development aid. I mean, everybody knows that there's a $70 billion gap in that right now. So these kinds of, and this is just one, and insurance is of course easy, but that's what we want to do because you know that something works, but you cannot bring it to scale, but you can be catalytic in the way that you push it through the door. And then, and this is now scaling to at least 10 million farmers, probably more in 7 countries, because there's a necessity. And I think the same goes for life and health, livestock insurance, other things. And then you go from insurance to other models that work the same way. And I think this is where the flexibility and the agility of capital like ours can come in, because like I said, we know we're going to give it away anyway, so we might as well just try and move the needle a little bit. And if you do it together, you can do it in a much larger scale. It's like a laboratory environment, and if we work together, we can make it go outside the lab, let's say.
So I'm going to come back on the collaboration piece and how we actually get to that. I almost heard the music in the background. It was a beautiful image, and we want to get there. But I don't know if you two have anything you'd like to add on that? Nodding heads, that's what a moderator always does to see. Yes.
No, absolutely. Just maybe to continue building and challenge also what just has been shared indeed by Stefan, and we work indeed closely together, and I think collaboration is indeed absolutely the key. But what I would like also to more share here is that we learned also the hard way that actually many of the donations, purely donations, don't necessarily work. So that's actually, that is a reality, and that's a claim we can make. And I think they only work when they are really embedded in a kind of catalytic approach. And we need to challenge the ecosystem indeed with respect to that. So what we have indeed learned, that is also part of our journey, and being, let's say, mission driven, and if you are committed to your mission, then you have to track your numbers, right? I mean, and as I shared, so with respect to that 100 million that we that we aim to achieve by 2030 on an annual basis, and where we are today at around 46. I think it is also very important that that was for us the motivation and the driving force to move towards impact investing. And success for us is really about creating sustainable impact. That's for us the success. Success next to, indeed, that mission that we want to achieve, of course, is how do we create that sustainability? Because many of those donations, they will not last that longer if either you need to continuously contribute to that or need to be much more catalytic to support so the investee or the grantee to work on a sustainable model that can bring then the innovation into a long-term effect. And I think that is where, certainly when we speak about healthcare, we speak about broken health systems, and we need to see how we can indeed build on that and how we can then support ventures, businesses, partners to make sure that we can bring it actually to a workable level and get into a sustainable system.
That sounds good. There's a lot to unpack in there as well, but yes. Cheyenne,
yeah. I'll keep it short and sweet. One thing that I'll do and I'll explain, we prime the pump by going beyond the check. That's kind of how we frame it. So as with our venture capital legacy, what we do is we join the board of each organization in our portfolio and help them navigate their growth journey to help them scale and help them set up the key indicators for them to succeed, which is fundamental for them. And after 23 years and seeing what it is that works, currently about 30% of our portfolio has been impacting over 1 million people all around the world across all sectors. So it's something that is needed. It's another aspect to the type of philanthropic money that is out there. And for us, the financial injection is the least important piece that it is that we have to offer by having that hands-on, tailor-made, strategic kind of support, which is also vital to make sure, because indeed, so many organizations, if you just give them a bucket of money, it's not necessarily a guarantee for success, let's put it that way. But it is also just going beyond what Matthijs also said. When we go out, which is after 3 years officially, we stop our financial support. It is our goal to have other investors that are comfortable, for example, because we took that initial risk of doing an early stage capital investment, that they continue the journey with them to make sure that they scale beyond and can ultimately reach millions of people.
Cool, thank you. So I'm aware of time and very bright lights, but as we come to kind of that halfway point, we did promise this would be interactive. So we can do this a couple of different ways. As you can tell, our panelists have a mine of knowledge to keep going, and I could quite happily just keep chatting to them. But I wondered, just to start with, are there any direct questions on what's been raised so far? And if so, does anyone want to be brave and put their hand up and do that sort of thing?
Or comments.
Or comments, yes, sorry, good point.
Criticisms.
Criticisms, definitely.
Hi, everyone. I'm going to be very bold because I'm probably the only one here in the room that doesn't belong at this conference at all, because we're technically a portfolio company or innovator, whatever you want to call us. With the Great Bubble Barrier, we deploy bubble barrier systems to capture plastic trash in rivers before it flows out to the sea. And we have been pretty, philanthropic funding has been transformative for us. Without that, we wouldn't be where we are today. I'm kind of curious because I'm going to be, let's say, from the point of view of, if you give people just a lot of money, it doesn't necessarily work. Donations don't have to work, and how do we make sure we achieve what we want to have? Raised up a couple of question points for me in my head. So just maybe thought-provoking. Mm-hmm. We have our biggest and most impactful funder is the one that has not given us any requirement of what we have to do with the money. Mm-hmm. Mm-hmm. They offer us a lot of support, and we take that support, but I've been offered much less money for a lot more requirements, mm-hmm. where other people are trying to tell us how we should be doing things. Mm-hmm. And so what about also entrusting mm-hmm. the organizations that are on the ground doing the actual work, that they probably know really well what's required, instead of someone, and I'm going to make it very black and white, sitting far away in an office.
Mm-hmm. Yep. So, yep, we like that. And are there any other quick, not quick, but any other comments just to get a feel for the room if people have got dying to share.
One in the back there.
Oh, well spotted.
Yeah.
I feel like I'm...
Good afternoon, everyone. Very useful discussion. So I have one sort of question more on the spectrum of uses of philanthropic capital. On one side, there's a lot of conventional grant making that continues to happen that is needed. And the other side, you have obviously catalytic funding, blended finance, and related. There's a debate out there in terms of how, where in the spectrum, is really useful when you're looking at scaling innovations and attracting commercial capital. And the specific question there is, like, some of the philanthropists out there, they're like, oh, we should never subsidize returns for commercial investors when we are trying to deploy catalytic capital. But at the same time, you won't have the right risk-return balance for them to come in. So I would be curious how the panelists think about, when trying to bring scaling innovations and bringing, let's say, commercial investors, but that may require sort of working with them in a way to meet them where they are. So curious about any thoughts around that.
Cool, thank you very much. If we just pause there, I'm going to very arbitrarily try and split those two comments. So we had the kind of the both the localized but also kind of venture funding where you give the money and let the people who know what they're doing get on with it and don't put too many targets around it. I'm paraphrasing, but that kind of approach, which I think, Cheyenne, that kind of seems to reflect a little bit on DRK's kind of original venture philanthropy approach. So I'll throw that over towards maybe yourself and Stefan. And then I think on the second one where we're looking at kind of catalytic funding, scaling enterprises, and this lovely question that always comes up is, should you be subsidizing other people's profits? I paraphrase again, but that kind of thing kind of comes in. We might throw to you and Eddie as well, if that's all right. So I don't know, Cheyenne, do you want to start?
I can definitely start. So very quick answer on this. Agreed. Fund early, fund unrestricted, and fund proximate leaders. That's what we do. So very short on that. And you're going to hate me. I do want to have one comment actually on the other question as well, but I'll again keep it short. We really believe that funding organization, well, impact investing itself is part of like a targeted effort and a collaborative effort to attract market capital. It's not to be the market capital. And that's something that we really try to install in the conversations that we have with fellow impact investors as well. Don't be the market capital, but be enabling to attract market capital. And sorry for the rule break, but I'll keep it at that.
It made me look so organized up until that. No, it's good. I don't know, Stefan, do you want to pick?
Yeah, I mean, I come from social enterprise, so I know what it feels like to do 70% reporting and fundraising and 30% of your actual job. That's wrong. It shouldn't be that way. So I completely agree that unrestricted funding is a really good idea, but I think that it's also one tool, because then the question is, if you work, I mean, I work for a corporate foundation in a corporate context, and the auditability of data and the KPI sets that you're paying into play a major role, and this is also catalytic. So I think both have a reason to exist, and they should be deployed at the right moment, because I think especially early stage in the beginning, when you just need runway to grow your enterprise, this is where you need unrestricted funding, because then you can just operate and you don't need to worry about everything else. And once you've reached a certain threshold and a critical mass, then you have enough team, for example, to do reporting, then you can pay into everybody's bucket, that you need to pay into, and you have the resources to actually also deal with all of the different KPI sets that are out there and all of the requirements and so on, and the bureaucracies. But I think it all has its raison d'être for different reasons. I think in a European context, for example, it's really important to have reporting standards, but you need data, and you need reported data to be able to compare and take stock of where are we, is this really happening, and so on. So I think there's a difference between the venture part and the growth journey. It's at different stages in the growth journey. But emotionally, I'm very much with you. There should be much more unrestricted funding.
I think also just to add to that, so from my point of view at Impact Europe, we're a network of about 300 donors, and no one's got this right. So there is a kind of element there of also just being clear about what you can and can't do. So like some donors, like the Corporate Foundation, can do that, DRK Foundation can do that, and it's about, on a donor side, not putting the pressure on the enterprise, but for the donors to find partners who can do the bits that they can't do, because together they're a lot stronger than apart. all the slogans are coming out, but you know what I mean? Like there's that kind of thing. So I think, yeah, that makes a lot of sense.
And one in-between element is to pay for
yes.
reporting consulting. I don't know, 60 decibels is one example. For you just pay for a study that's being done, that's third-party verification, auditable data, where you get the raw data and then you can just hand it over basically and say, look, it's not us saying this, it's the person on the street who, in a proven manner, says that what we do works. And that's like a mezzanine measure to kind of help in between and answer to both of the questions. Yeah.
And then moving on to the second question, which I terribly paraphrased, but I'm getting confident nods. That's good.
Yeah, I think I catched most of it. So, but I would like to get back to the first one just briefly, and that's more because of course, I do believe in grants. I mean, and that's what we have done from let's say the establishment, and we still do. Just we need, of course, also just the bottom line. We need also to realize that there should be some kind of accountability related to it, and that's what we are speaking about. Of course, there should be no harm, for example. There should be a number of things that we need indeed to look at, and I think that is what is very important. But I also do have very great examples that are actually moving, let's say, from grants to sustainable models, and I think that is also very important. That's what we look for. It's not that we should not do it, but I think we need to build on it, and I think that is very important. So moving back, let's say, to more the spectrum, let's say, and also with respect to the ventures and the investment, yeah, I do believe in the continuum of capital, and I think that is also very important that each of us has probably a role to play. But I think what is very important is that we need to think on how we do position each other in that space and how we handshake more to create, let's say, more trust in what makes more sense to do and what is impactful, let's say, in terms also of based on the experience that we can attract locally. And absolutely, that is what we need to focus on. So we need to work with the right partners, with the people who are on the ground, who understand indeed what needs then to happen, and then make sure that we deploy then the capital in a kind of continuum manner to make sure that we get to the success that we would like to see. We are not there, actually, for us as a Philips Foundation and Philips Foundation Impact Investments, we are not there, let's say, for the complete maturity of the businesses. So at some point, we do see that it is not our role, but more the role for others that could be venture capital or could be institutional, that they need then indeed to take then the role to continue with the mission. We see our role really in that early stage, whether we call it a value of debt or we call it about actually more the high-risk profile. That is the area where we see that we have a role to play, but we would like to be much more catalytic to attract also others to get closer.
I think I'll come back to the first remark I made, is that as a mission-driven investor, that ultimately you have no flexibility on the mission. So if you look at that continuum of market rate return, we accept more risk and we might accept a lower return. It also depends a little bit on, I always distinguish two types of companies. You have these kind of solutions for niche markets, which generally have a tendency to have a comparable risk profile, but a compromising return perspective. So generally, they are not that much potential as venture-like returns. Or you have initiatives that are way too risky because they are very early stage, but ultimately they have the return potential. And it differs a little bit on which is the core of your portfolio, what type of return you can generate. I would say that with the first group, you're likely to compromise returns. And on the second group, you are likely to have a very volatile return. And that's also what I would like. So if you compare it to market, ultimately in kind of, let's say, SFDR 6, so no true sustainability objective. If you compare that, the distribution of returns, it's about, I think, that the differences between the best performing and the lowest performing will be as big as with impact funds. So there is no market return. There's a lot of differences. I can say that for us, we've been investing in health technology for 20 years. Our IRR is 10%, but it's gone up and down. You have to. I think that the main thing is you have to have patience. So structure of a fund limits you to be a long-term investor, and you have to keep your calm. So you have to accept that it's very illiquid. You have to be there for a long time, and it can go up and down. Don't get nervous about bankruptcies once in a while. You might have, but maybe that's I would say that's traditional for venture capital if you are in this second group.
Excellent. And anyone got anything else to add? Because I've just been scribbling down things, but
maybe just one comment actually, which is I think it was mentioned briefly earlier, but it is very important indeed to mention that there is much more than just the financial instruments we are talking about. And that is certainly important in the space that we are acting in. So actually next to, of course, the financial means that we speak about, access to expertise and access to technology, for example, so also to the partners that we work with, that is also very important. And that's also rooted in the work of many of us that we try indeed to do here as well. Yeah.
Excellent. So yeah, the non-financial as well. I was also scribbling down, I like the patience and keep calm, but I also like the mission being non-negotiable. And I'm stealing, I'll be honest, I'm stealing the phrase about targeting to attract market capital, not being market capital. And I think there's a lot of work that we need to do to understand where the gaps are and where this sort of capital is making a difference that wouldn't be otherwise filled. And sometimes that may not be always the case. So there's a little bit of work to be done, but yeah, I'm just stealing lots of things for my calls next week, which is good. I don't know, we can continue the conversation, but also very aware if anyone's got any questions or comments or excellent, that was quick.
Hello, thank you very much. My name is Eddine Teodoro from We Serve Forward Foundation. I have a weird question, actually. From the 2 days that you spent here, what do you think we can do as foundations to work with the institutional investors? From the conversations you had and the panels and the interactions, where can we start practically to work with them? And if there are any institutional investors in the room, please let us know also your side.
So,
Yeah, I think my first question was aligned with what was just asked, but just to rephrase that also, what strategies have you seen work or potentially could work to attract or work more with the institutional, commercial, mainstream investors? And second, from one of the panel we had here yesterday was about the role of government, where should they step in the work of investment. So just want to understand also what do you think is the role of government or the government bodies in your line of work?
And then before we ask the panel to input on this, I'm going to try and put people on the spot. Are there any institutional investors in the room? Yep. Don't be shy. Don't bite.
On this side, on the left.
Oh, you spotted quickly. So, I don't want to put you on the spot, but if you've got any thoughts to add to this, or we can come to the panel.
I was actually just before that brilliant question, I had the question in mind.
Please do.
I think indeed, your world and the institutional world are very sort of separated in a way, for probably good reasons. As an institutional investor, you have all the buckets and the mandates and the restrictions and the requirements. Also, because we have our fiduciary duty, we need to organize our processes through all kinds of procedures to be held accountable. And my question was actually, what would you advise us? What can we learn from you? Maybe that's also an easier question, because happy to have a chat afterwards. Maybe things that are the strengths of the institutional world. But I would be really curious to hear what you would, recommend us as the more complex, larger groups, maybe.
Fantastic. And to be honest, we're all very happy, because that's kind of what the whole purpose of the panel is about. So thank you. So we won't lose the extra question about the role of government as well. But I don't know who wants to kick off on either side of that same sentence. I know we've chatted.
Just building on what you just said, just thank you. Because this, obviously, there's a need for both sides to talk to each other, to understand each other better. What I feel like is there's a language gap. It needs to be translated, because, like I said in the beginning, for me, it's often lots of jargon and then talking about challenges that I have no idea existed, in terms of regulatory environments and whatever else it is. But at the end of the day, the motivation why people are here is often the same. It's just that they come from different planets, and you kind of need to find a way to connect this. And maybe one way to attract more institutional capital would be to talk about concrete cases and to really go through the motions, say like where did we start, and also share like failures and risks, a little bit of a playbook of sorts maybe. And that's something that I think should be done together by some kind of working group that you say, okay, if you want my people to understand what we need, you need to say this. And then you have a glossary so everybody kind of gets it. But I think the most important part is to document successes and failures and challenges, and then kind of have a joint smallest common denominator. And I think, Eddine, that's what you were pointing to. What can be the starting point? And I think this is really like small-scale pilots in environments that are representative for both, and then actually do it, because then you have a point of reference, and from there you can scale it out to different. You can think about healthcare, whatever. It's like in our community of practice, it was clear. Okay, it's healthcare. It's in our case, it was in the global south. It was sub-Saharan Africa. And then we found out that we have the same pipeline and the same portfolio. So, and then you start working from there. So that's a different conversation to be had, but that's, I think, what needs to be done. Sit together, talk to each other, try to understand, move towards each other, and then do something.
Yeah, maybe just a few more things, and probably just different jargon saying probably the same. But actually what we see, in terms of, for example, what Eddine indeed shared, of course, it's more a kind of a reality check. That's actually what you have been sharing, and actually that's what we have been seeing indeed in the last, let's say, 1.5 day. Right? I think, and also when it comes indeed to how to respond and how to attract, let's say, institutional capital, and I'm very happy that at least you intervened, so that and there are good sides actually to that specific part. But maybe before we get to the positive side, the challenge is if we look to that reality check, so and we look to that spectrum, right? So then we will see that like there is a huge gap between the impact investing in its meaning, and then indeed the institutional, let's say, part, and of course in between we see a lot of work happening, let's say, from the asset managers, right? And that is the reality we all have. On the other hand, we all say it is very important so that we do impact investing. So we all actually, I think almost nobody disagrees with that, because that's my experience in the last 1.5 days. So everyone knows when we talk about impact investing. But at the same time, we try to fit it in structures that are established and existing and doing work in a specific way with specific type of risk appetite and specific type. So if we keep doing what we are doing, we will not get actually to the other stage. That's simple. That's what, if we want actually to get closer, and that is do we want to just recognize the existence of each other and then coexist? Or do we need to bridge the gap? And I think the only way to bridge the gap is that we need to get out of our comfort zone. I think foundations, and what I have seen from corporate foundations, that they have been going from out of their comfort zone, actually going to explore the impact investing space and looking towards actually the other side. And that's what I do expect also from the other side. So that actually that we need to find a way on how we can get closer. Because what I see and what I realize is that we need probably 3-4 exits before we can move from, let's say, impact investing space to the existing established investment space. That's my 2 notes here.
Absolutely, and I don't want to, I'm not, if you guys want to come in on this, are you?
Yeah, well, I took a little bit of a different angle, but I think it builds upon what was said, is that ultimately, if you have to acknowledge that if you are like a 200 billion asset owner and you're a fund manager that invests 500K in a startup, there is a huge difference between you. And the question is, where do you meet halfway? And I don't think, so a lot of discussions I have, so we are also raising funds and we are investing with foundations, with family offices, but not with institutionals, because basically what they say is, I want to invest at least 20 million and not have more than 20% of the fund. And I say, well, that's fine. Then basically you're saying, enlarge the fund. Yeah. But a larger fund generally leads to larger tickets. What we have a need for is at the very start of a company. So do not force fund managers to, based on mechanics, to do larger funds. The same holds with structures, I would say. If you're a medical device company and you have a new technology that's being developed and tested in a research institute or in an academic medical center, and you start a company, you have 20 years to go before your exit. That's just average. So basically, a 5+5 fund structure does not allow for that. I mean, you are 3 funds down before you're there. So I raised the question, can we talk about structure? And then people, I mean, if they are at the executive level, they say, yeah, I totally understand what the developments are, so we should do that. And you drill down in this organization, everybody says, well, I mean, it's all nice, but we know our structure, 5+5, so please come back with 5+5, but otherwise it's too difficult for me. So my call is on, again, I'll put it on my forehead after it, on flexibility. I mean, if you want to meet halfway, don't talk about the risk or return, but really a little bit of flexibility to make sure that what is happening on the ground aligns with what institutional investors are seeking for. That also means that we have to professionalize ourselves. And I mean, I wouldn't say lower your criteria or your conditions. I mean, the standards have to be met, but it has to be. You have to have a little bit of flexibility on things that are sometimes just grown into and are not just. There is no good reason not to deviate from.
But yeah, and I think also that kind of stands for a lot of the things we've discussed where, well, as a very starting point, the idea of solving market failures and market gaps by using the same tools that got us there in the first place is fundamentally a bit of a strange idea. So there has to be a flexibility to approach these things differently, I feel. But also the idea of structures is quite a scary one as well, because we all get paid within our organizations to work in structures that are comfortable. So it will take some confidence and some kind of stepping out. But I was actually going to ask you, like, you're coming at this from investing right down. So when Matthijs mentioned, you know, small ticket sizes, do that, and you have a slightly different model, like, how do you see what's being said here, but also, how do you actually answer people, or how do you get people to come a little bit closer to you? Because I think that's the bit that Stefan's mentioning. How do we gently?
Well, I think actually, I mean, it comes to no surprise that there is a gap to be bridged to some degree. But one thing that most of us are coming in, you know, some at ideation stage, but also pre-seed, seed stage. So there's then the gap gets bigger and bigger. And in my opinion, it's not necessarily the gap that needs to be filled by the people in the room here now and us. There's more actors across the continuum of capital as well that could come in. So making sure that the financiers or the other types of supporters and strategic partners talk to one another, and you can be the linking pins towards that full chain. That is also a role for us to play, and that does not require you to let go indeed of your criteria or to let go of your model and your mission in order to still be able to provide that full type of support that these organizations need. So it's also about acknowledging where do you sit on the chain, what can you provide within your boundaries as well. And indeed, one thing that I think Matthijs said that really resonated, be patient about it as well. It takes a long breath. It doesn't, the true fundamental change doesn't happen overnight, and that is something that we also need to acknowledge. So it's not necessarily a gap that needs to be filled by two. There's a lot more in between.
The job gets bigger. And I think that's fair. I'm aware of time, but if anyone has any questions, we can gather them. And the whole point about this panel is that the discussion doesn't stop when the buzzer goes off. I think everyone's going to be around, so conversations carry on. So if you do have questions or comments, lovely to gather them in now. If we have time, we'll try and answer them, but otherwise we can continue afterwards. And I am struggling to see, but if anyone's going to raise their hands, there we go. Thank you.
Hi, first of all, thank you for such an engaging discussion. It's been amazing to hear all of your opinions. I no longer work for an institutional investor, but did previously, and so can say firsthand that having that mission-based capital to take the first few layers in the capital stack is highly important, and for us was often sort of just the green light to play, or you know, opened that first gate for us to look at investments that we wouldn't have otherwise been able to. I really love the idea of creating sort of like a synchronized pipeline across all of the different players that can provide those different types of capital. It sounds like what's missing is a way to connect everybody. And I really love the comment that was made that that's sort of everyone's role. But I was wondering if you had any other ideas of how we can all sort of come together and connect on these things.
So, I mean, I can do a very simple, self-interested little answer to that, so enjoy this, everyone. As part of the Impact Europe Network, we have a gathering coming up in Malmo that attracts all people from along the spectrum of capital. But I think your question goes a bit more deeply, how it stays alive throughout the year, but I had to put the pitch in. Maybe if you've got a short snap to that, and then, yeah, we can just wrap up.
Absolutely, and it starts, in my view, it starts also with having a common language, and I do agree with that. I mean, if we keep using, let's say, first laws, I mean, that is not really attractive from an impact side, right? I mean, although maybe we may mean the same. So I think we need to get into some kind of common sense with respect to how we use, indeed, also language between, so let's say, an impact investing or philanthropic side, and then the traditional, let's say, investing. And there is a role and an interest for each of those, indeed, to play. And I think, but if we use terminology that is more from de-risking and from lower risk, actually, perspective, instead of actually focusing on what the impact is and what we want to drive to, I think that is the start. And the starting point, it means, indeed, getting closer, having discussions. And I think that is what I wanted to say with respect to the positive side. Some of those interactions do take place. And so, yes, recently I was very pleased, actually, to have the discussion, indeed, with the Achmea Foundation team, with the Achmea investment team. So, I mean, that's actually how you get closer to understand how they do their work, how we do our work, and that actually enables that discussion. I think the other side, what also helps, and that is what is happening also outside there. So also the customers are pushing for this, even if we want to do it differently, and that is my actually hope as well, so that we will be also driven towards getting together. We have no choice. And there should be a kind of sense of urgency to act.
I think one of the key questions is going to be who's the convener? Mm-hmm. Because you need an overarching kind of structure, somebody where maybe Impact Europe, you know, like, but a network or a platform that everybody feels comfortable in, to kind of, and then there should I mean, in the beginning, this needs to be closed doors, Chatham House rules, kind of put the cards on the table style, because otherwise you're not going to get to an actual result. And this is, I think, something that we still need to figure out, but we have more than enough organizations in this room alone who would be able to do something like this, house it, push it, and so on. So, yeah, as a takeaway, maybe from the conversations following, we can take that up somehow and ask for the conference also to follow up on it, because what's the worth of a conference if you don't have follow-up action, right?
Mm-hmm. And if I can just add one thing, which isn't self-promotion, but it is promotion of a few guys here. Something like, for example, the community of practice and health, which I know we share, Forward Foundation has also been great at stewarding. Those are types of convenings, and yes, these are primarily foundations, of course, so they're coming in at similar stages, but just having dedicated moments to convene, dedicated moments to share pipeline, lowering the bar for so many organizations that are there, that already opens so many opportunities. So making sure that you talk to, like, for example, also on our team, we have 2 people dedicated to just talk to sourcing partners and to just talk to follow-on funders, because there's real win for the organizations that we're supporting by having all those doors that could potentially be open. And that's also something that the community of practice and health, where you gather all these different types of funders that have different vehicles to make sure that you connect with one another before you go to the
Even though we don't have an institutional funder in the community. And make it super low threshold. So sign an NDA so you can share whatever information there is that's necessary, and that's it. So no big kind of hurdles, I think.
So
I think that was one burning question.
Well, I think that overall we also have to accept that this is a very intransparent market anyway. So I mean, this is not only for impact investment. This is for the general investment field as well. So I think that our attitude is that we are as transparent and as open, and we have to be out there to know what is there and meet other investors. Basically, that is our business. But ultimately, I accept that that it is a little scattered.
I think that's fair. So I'm aware that there's
one question. We could do it quick.
Do it quick? Okay. Don't know why I'm so blinded by the
leading.
It
is bright.
Thanks a lot for noticing. And here's a crazy idea. And I know much more about the financial world than I thought I'd ever do, because I'm originally an engineer, but it's part of the job of starting a company. I've been running it now for a couple of years. There's a lot of funding in the hardcore impact space that doesn't expect any returns. It's grants, it's donations, money's gone, written off the moment it goes out the door. Then we have a lot of new impact investment now, which is kind of skittish because they're worried about the returns that they might be getting. Funds have difficulties raising a first new fund because they have no track record, and it's tricky to then get any LPs that would buy into that. I know there's been ways around that say, you set up a fund that doesn't have any return expectations, so you kind of prove a business case. What if we align interests of, let's say, Bayer Foundation, Philips Foundation, the DRK Foundation, and we set up a specific, let's say, fund that everyone gives their money in, they would have given away anyways. We, in our minds, write up the return expectation, but look at what we could create which would in the future attract market capital, and then use that fund to deploy it into organizations that still have to do reporting, that still also pay back into that fund as if they would have received investments, which can in turn help, so an evergreen, basically revolving loan fund, with the goal to still deploy the funding, but at the same time proving the business case that there is attractive return in it, so that once we've proven that, without all these other risks that are outside where everyone is not making that first step, we can then finally bring new capital into this market.
Please follow us in the community of practice, but that's exactly what we do.
Yeah.
Okay. Yeah. Great.
That's a great answer, but yes. So I'm aware of time. We've got lights flashing at us up here. I don't want to take up a coffee break or anything like that. So, I think our panelists have just shared quite a lot. I know they have a lot more to give, so please don't let them get to the coffee. Happily stop them, continue conversations. But I'd also just like to thank you as well. Again, it is the second day of the conference, and it's really lovely that you've all stayed till the end as well. So thank you very much. Give yourself a wonderful round of applause. Thank you.